Hi everyone, welcome to this session of the Tiger Academy, US Stock Financial Statements for Beginners. Some of you may ask, now that you've walked me through how to categorize the key metrics of a financial statement and shown me the key indicators of an earnings report, when I do it myself, in what order should I go about analyzing the data? The short answer is, it differs from person to person. But if you don't yet have your own technique for reading a financial statement, you can look at the quick read method of Mr. Jingwei Chen, Director of Investment Research at Tiger International. I've summed up his method for you in 4 phrases that are easy to remember. I'm sure that after this lesson, you will be able to analyze the financial statements of any company in a logical step-by-step way. Visualize the big picture. View the statements side by side to find the structure. Conduct a 4-step analysis. Take all internal and external factors of the metrics into consideration. Now, let's take a look at the first phrase. Visualize the big picture. Do you remember how we learned at the beginning of the course to visualize? The graphic profile of the 3 main financial statements is shown in the following figure. The income statement reflects the operating results of a company over a period of time. Simply put, how much money did it make or lose? The balance sheet shows a company's financial health, including how much it has in assets, cash on hand, and short and long-term liabilities, and which of them is interest-bearing. All this information is contained in the balance sheet. The cash flow statement shows cash inflow and outflow, as well as the ability of a company to raise and manage funds. In the cash flow statement, we can easily see whether a company has enough cash to repay short-term current liabilities, and therefore whether it will be able to continue to operate in a healthy way. In other words, the cash flow statement shows how much cash a company receives, how much it pays out, and how much remains in its accounts during the period of time. Next, the second phrase. View the statement side by side to find the structure. Once you have an overview of the 3 statements, you can look at how they relate to each other. Let's start with the cash flow statement. The cash flow statement is derived from, and is supplemental to, the income statement and the balance sheet. Cash flow from operating activities is derived from the income statement. Cash flow from investing activities is derived from the left side of the balance sheet, while cash flow from financing activities is derived from the right side of the balance sheet. Here's a chart that illustrates the relationship between the 3 statements. Next, the third phrase. Conduct a 4-step analysis. After understanding how the 3 statements fit together, let's now do a detailed analysis of the data found in them. We'll do that in 4 steps. Step 1. Find the key data and analyze whether there is anything unusual about it. When looking at an income statement, you should pay attention to the following important numbers and ratios: whether the gross margin is below 20%, whether sales and general administrative expenses and R&D expenses have an abnormal increase, and whether ROE is above 15%. In the assets section of the balance sheet, we'll focus on whether cash and cash equivalents are enough to cover current liabilities, including things like short-term debt, and whether accounts receivable and inventory are growing a lot. In the liability section of the balance sheet, we'll look to see if accounts payable, short-term debt, or goodwill have grown in a big way. If you don't find any problems with the data, you can move on to the next step. However, if you find irregularities, you'll need to use what you've learned in previous lessons to dig deeper into the financial statement, or do more research. If you can't find any concrete reasons for the irregularities, you might conclude that the financial statements aren't what they seem to be. Step 2. Compare historical data to determine if the performance is sustainable. When judging a company's competitiveness, sustainability is very important. For example, let's say that 2 students both got 95 out of 100 on an exam. One student's scores are always above 90, while the other student's scores are usually in the 60s. Based on this, we can come to the conclusion that the first student's score is much more credible. That is not to say that the other student is no good. It just means that, given the historical record, the first student is more likely to keep getting good test scores. That, in a nutshell, is the value of comparing historical data. Likewise, a company that has consistently earned a profit over the past few years is more likely to do so in the future than a company that's had one good recent quarter but has historically lost money. So, when analyzing key metrics in a financial statement, you should compare the data from the current period with that from at least the last 5 years in order to research a credible conclusion about a company's performance. Step 3. Quickly find companies worth investing in by using a cash flow profile. Previously, we talked about the 8 combinations of a company's cash flow data, according to which we drew 8 profiles. With these profiles, we can quickly tell which companies have investment potential and which ones we should stay away from. Cash flow profiling is a very useful tool to help us quickly validate whether a company fits our selected criteria. Step 4. Compare a target company's data with that of its industry average, as well as with that of its competitors. Comparing the financial data of listed companies with the industry average or with that of competitors will broaden your horizons. An ROE of 20% seems good, but if the industry average is 30%, then the performance of a company with an ROE of 20% is actually well below average. By comparing data with industry averages and competitors, you will avoid trying to assess a company's growth rate in a vacuum. A growth rate below the industry average indicates that a company is losing market share as well as its competitive advantage. As a result, the company may eventually fall completely behind in the market. Comparison with competitors may begin with key data in the balance sheet and the income statement. For selecting key data, refer to Step 1. You can find same industry data in the TigerTrade app, which clearly displays changes in the data over time along with industry comparisons. And the final phrase, take all internal and external indicators into consideration. The 4 categories of financial indicators are profitability, growth, operational capability, and solvency, as summarized below. By using these 4 main financial indicators, you'll make the leap from analyzing company data to assessing company performance. You will be able to understand the financial statement better and make a decision about an investment faster. You'll also be one step closer to being able to conduct quick reviews of financial statements when researching investment targets. I'd say, at this point, that all the pieces of what you've learned are coming together, aren't they? I'm sure that now you can pick up the financial report of any US-listed company and easily, thoroughly, and logically figure out what it means. Doing a quick read of the 3 financial statements, you need to look at them as a whole. The 4 phrases that I gave you include the concepts of visualization, understanding, analysis, and validation. All you need to do is plug in the data you'll find in a financial report. That's all for today. Memorize those phrases. See you next time.